Good morning everyone and welcome for today's session. In chapter number 2, that is secondary market operation, previously we were discussing about the mutual fund, its scope, and we have started with its type. Again, we have a quick recall. Mutual fund are the fund established in the form of trust by a sponsor to raise money by the trustees through the sale of unit to public. Investopedia defines a mutual fund is a type of financial vehicle that made up of a pool of money collected from many investors. If we want to take it in a very simple words, mutual fund collect the savings from small investors, invest them in government securities, corporate securities, debt, etc., and earn income through interest, dividend, capital, etc. And mainly it works on the principle of small drops of water make a big ocean. Then we have started with the types of mutual fund. Amongst the first one is on the basis of operation or execution. There are two types: close-ended fund and open-ended fund. The close-ended fund have certain limits, that is the amount to be raised is predetermined. The opening date and closing date of the fund is also predetermined. An investor cannot invest after the fund closes, and there is certain lock-in period applicable to such type of close-ended fund. It means once the investment is made, then investor cannot take back their investment for a specific period of time. Their investment get locked for that time period. This type of fund are called as close-ended fund. Generally in India, tax saving type of funds are close-ended fund, while the open-ended fund are opposite to it. In open-ended fund, the opening date is predetermined, but there is no closing date. There is no fixed amount that company want to raise from mutual fund. It means an investor can start investing at any point of time he thinks best for him, as well as if any kind of need arise, or if investor want to sell their units, their mutual fund, they can sell at any point of time, and at a market rate he can sell his number of units and redeem the amount. So there is no any limit for investment. There is no any fixed time period regarding investment and taking back your investment. Those type of fund are called as open-ended fund. Majority of all in mutual fund schemes are open-ended scheme. So till this point we have completed in our previous session. Now there is another type of mutual fund. They are working on the basis of income or investment objectives. For what purpose the investment is done in mutual fund? On this basis there are various type of mutual fund. Among this, the first one type is income fund. The name itself defines that the fund is aiming to generate regular income for investors. Hence, those people who want to earn a regular income from their investment are generally investing in income fund. Generally, a salaried person or a retired person, or the investors who are at the beginning level, or the investors who do not want to take more risk are the major investors in this type of fund. Those investors who want regular income and do not want to take much risk, those type of investors generally invest in income fund. The investment, the amount collected through this fund are invested in those securities which provide a fixed and regular income. This type of securities are equity share, preference or debenture or debt instrument are those instruments which provide fixed income, like 12% debentures. So the debenture will provide 12% fixed income irrespective of profit or loss. Irrespective of company will earn profit or loss. So the major investment of this fund are done in debt instrument or on those instrument where the fixed return is guaranteed. The risk averse investors generally invest in income fund. Those investors who do not want to take much risk, like retired people, salaried people with a very low salary, or a middle class people, generally invest in income fund. Now the next is growth fund. Growth fund are a little bit different from income fund. In income fund, the major aim is earning regular income, while the growth of fund, that is the growth of our total investment, is neglected. While in growth fund, the focus is on capital gain, is on increasing the value of our total investment rather than earning regular income. Here the investment is done with the aim to increase the total value of investment rather than earning regular income. Those investors who do not want to earn regular income but want to take the advantage of capital gain, want to increase the total wealth, are generally the investors who invest in growth fund. Generally a business class people or a salaried people with high salary are generally those investors who want to take risk, or those investors are with high risk capabilities, high risk attitude, generally invest in growth fund. In income fund, the risk is less and hence the return is also limited, whereas in growth fund there is more risk and hence the return is also comparatively more as compared to income fund. The amount collected through this fund are invested majorly in the equity segment of share market, whereas the equity shares are not giving a regular income, but the equity share, investment in equity share will ultimately lead to increase in the capital of investment. Hence, those investors who do not want to earn regular income but want capital appreciation, want to increase their capital net worth, are the investors who invest in growth fund. So, these are the basic of income and growth fund. That is all about today's session. Have a nice day. Goodbye.